Good morning. It is Thursday, March 19th, 2026. This is your deep dive daily briefing. I am your anchor, Cora, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East has reached a moment of extreme tension. Following nearly 3 weeks of high-intensity conflict, the situation remains highly kinetic as United States and Israeli forces continue sustained air operations against Iranian military infrastructure. Overnight, reports from regional monitoring groups confirmed a series of heavy explosions in several Iranian provinces, aimed at degrading long-range missile capabilities. This military pressure comes as the international community grapples with the reported death of the previous Iranian supreme leader and the subsequent hardline stance taken by the successor regime. While certain diplomatic channels in Geneva remain open, the rhetoric from Tehran suggests a readiness to endure a prolonged confrontation, leaving the prospect of a regional ceasefire in a state of extreme fragility as casualties and displacement continue to mount across Lebanon and the wider Levant.
Transitioning from the front lines to the broader global economy, the narrative is being driven by a profound sense of uncertainty as central banks navigate a new era of structural volatility. Despite the immense pressure from the energy crisis, the International Monetary Fund has maintained a global growth projection of 3.3% for 2026. This resilience is largely attributed to the adaptability of the private sector and the front-loading of trade activities by major importers ahead of anticipated policy shifts. However, the visceral impact of the blockade in the Strait of Hormuz continues to filter through to consumer prices. Crude oil remains stubbornly high, trading well above $100 per barrel, which has prompted many advanced economies to implement emergency fuel monitoring. In Southeast Asia, nations like Thailand and the Philippines are seeing a significant impact on their manufacturing margins, as the cost of energy-intensive production rises alongside the increased freight rates associated with the current maritime instability.
In the realm of finance, all eyes are on Washington, where the Federal Open Market Committee has just concluded its 2-day policy meeting. In a move that market participants are calling a hawkish hold, the Federal Reserve elected to maintain the federal funds rate in the 3.5% to 3.75% range. The updated summary of economic projections, released late yesterday, suggests that while the Fed acknowledges the resilience of the labor market, it remains deeply concerned about the inflationary fire fueled by energy costs and new global trade tariffs. Investors are particularly focused on the dot plot, which now indicates a more conservative path for interest rate cuts in 2026 than previously anticipated. On Wall Street, this cautious stance has led to a period of consolidation, as institutional capital weighs record-breaking corporate buyback authorizations against the reality of higher-for-longer borrowing costs in a wartime economy.
Turning our attention to the technology sector, the focus remains on the massive build-out of artificial intelligence infrastructure and the arrival of the agentic era. During the ongoing GTC 2026 conference in San Jose, industry leaders have confirmed that the AI inflection point has officially transitioned from generative models to autonomous agents. NVIDIA has showcased its new Blackwell Ultra architecture, designed to deliver a 50-fold performance increase for these complex agentic workloads. Simultaneously, major cloud providers like Microsoft and Google are reporting a record surge in capital expenditures as they race to secure the energy and hardware required to sustain these localized tech ecosystems. However, this growth is facing a physical ceiling, as AI data centers are now projected to require an additional 92 gigawatts of electric power globally by next year, prompting a radical rethink of energy procurement and the potential for dedicated power generation facilities.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, currently facing their most severe stress test since the pandemic. The Strait of Hormuz remains in a state of near paralysis, with only a handful of outbound crossings recorded over the last 48 hours. This blockade of a waterway that handles 20% of the world liquid energy has forced every major ocean carrier, including Maersk and MSC, to officially suspend transits and reroute vessels around the Cape of Good Hope. This detour adds up to 14 days to voyage times and has triggered a massive spike in war risk surcharges, with some fees reaching $4,000 per container. Logistics providers are warning that even if the strait reopens soon, the ripple effects on port capacity and equipment availability in hubs like Jebel Ali and Salalah will be felt for months. As the conflict spreads, 72% of trade professionals now identify geopolitical instability as their primary enterprise risk, leading to a dramatic acceleration of regionalized supply chains. That concludes our global briefing for today. Thank you for joining us.